Hello and good afternoon in Taiwan. I'd like to thank Economics Daily for inviting me to join the Global Economic Trends Forum. First, let's start with some macro views. As we think about 2022, clearly the most significant aspect has been not just the rise in short-term interest rates, the Federal Reserve acting 6 times to raise interest rates currently to 4% on the upper bound in the US, but it's also about how different that has been from the expectations that have existed, particularly over the past year. Clearly, the reason for this very significant and sharp rise in interest rates has been the challenging backdrop of inflation, not just in the US economy, but really more broadly. As we think about the economic impact that this is having, we are seeing financial conditions clearly tightening via the rise in interest rates, as well as quantitative tightening, as well as just the impact that inflation is having on things like consumer and business sentiment. Moving forward, it will be very important that we see inflation, which remains somewhat entrenched and sticky, to begin to decline towards the Fed's target of 2%. As we learned from the most recent FOMC meeting, the Fed remains very intent on raising interest rates, getting to a restrictive level, and then holding interest rates at that restricted level for a prolonged period of time, really to see that cumulative effect begin to work, reducing economic activity, bringing supply and demand into better balance, and ultimately leading to price stability in the economy. As we look at financial markets in 2022, there are a couple of fairly unique circumstances that have occurred that investors really haven't witnessed very commonly historically, and that is the decline very broadly in asset classes, the significant drawdown in equities at the same time that we've experienced this fairly substantial rise in interest rates. So this has really been about Fed tightening and that interest rate backdrop really impacting asset prices. Now, turning to equities first, what we've seen, despite fairly resilient corporate fundamentals, the downdraft in equities, the bear market, has largely been triggered by that re-rating, so lower valuation multiples hitting the overall level of stocks. Looking at the most recent earnings season, that resiliency is starting to be tested. So while companies have generally been able to continue to show positive revenue momentum, below the line, if you will, we're starting to see some margin pressures creep in, and earnings are starting to show a little bit of that crack. Certainly one of those headwinds has been the strength of the dollar, which certainly for multinational companies has started to impact their overall earnings growth profile. Moving forward, certainly it'll be the extent to which the economy declines or growth deteriorates, due in part to that restrictive policies of the Federal Reserve, and that'll certainly be something to watch in the coming quarters. When thinking about the fixed income asset class, especially as it relates to generating income in a multi-asset portfolio, there are really 3 things that we look for. First and foremost is the attractiveness of that level of income to the portfolio. Second would be the prospects or potential for total return from those investments. And then very importantly, the third element would be the potential for fixed income securities to offset some of the volatility you might have in a portfolio, especially in the occurrence of an equity market drawdown. Now, looking back to the last year, it was really very difficult for fixed income assets to really deliver on any of those 3 kind of key objectives that we would look for. That said, the very significant move higher in interest rates that we've experienced in 2022 has dramatically changed the landscape within the fixed income markets. As yields have risen, we know that bond prices decline. If we were to look at the broader investment grade corporate bond universe, for example, yields have risen from below 2% a year ago to now nearly 6%. That's corresponded with a drop in bond prices of in excess of 20 points. So a very substantial repricing within the corporate bond universe over this past year. When we think about the overall risks in markets, I think investors are very accustomed to thinking about things like equity market risk, credit risk, or interest rate risk. I think 2022 has really reminded us that there are other risks that at times we really need to deal with as investors, and geopolitical risk is one of those key ones we've been experiencing of late, whether it's the Russian invasion of Ukraine, continued ongoing tensions between the US and China, or a broader energy crisis that's impacting many parts of the world, the Eurozone in particular. I think now while these conditions could deteriorate going forward, they are certainly things that have already been impacting markets, and we'll just really need to continue to watch and evaluate that impact as we move forward. You know, in terms of black swan events, those are certainly almost by definition, very difficult to predict as they're unknown, unexpected, and really can have a fairly devastating or wide-ranging impact. I think other events that maybe are more gray swan, where they are known, although they're considered to be unlikely, those are things that certainly keep us up at night and generally are related to things that we do already know. So an example would be further deterioration in the war in Ukraine, something that would bring other nations more directly into the conflict. That certainly could be a significant risk element to markets going forward. 2022 has been a remarkably challenging year for investors, largely due to the concurrent declines across markets, meaning both equities and fixed income securities have experienced fairly substantial declines. In fixed income markets, it was really directly related to that rise in interest rates we've seen. In equities, as a response to that rise in interest rates, we've seen bond prices decline quite meaningfully. Now, as it relates to the performance of our multi-asset income strategies, going back a year, we were really positioned more in equities, had really had a difficult time finding attractive opportunities within fixed income markets, and dividend-paying stocks in particular were a little bit of a haven with the expectation for continued strength in corporate fundamentals. As markets have really re-rated, we've found tremendous opportunity to reposition our Franklin Income strategies away from equity securities, particularly those equities in some of the outperforming sectors. So certainly energy has been a real outperformer, but even beyond that, things like utility stocks, healthcare, major pharmaceutical companies in particular, as well as consumer staples have all been fairly resilient parts of the equity markets where we've been able to reallocate and really take advantage of some of this tremendous repricing that has occurred within the fixed income markets, initially adding to some of our non-investment grade or high yield corporate bonds, but then as interest rates continue to drift higher, a little bit more willingness to move out the curve, take a little bit more duration and interest rate in the portfolio, and that's where investment grade corporate bonds have really stood out as one of the premier opportunities that we see in the markets today for our Franklin Income strategies. Moving forward, we certainly do expect some deceleration in the economy, potentially even into somewhat of a soft landing or mild recession. And it's in this environment that we expect fixed income securities, higher quality in particular, to really perform quite well relative to other assets.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。